Hello everyone. In this recording, we are going to start to discuss the concept of budgets. Now, basically, a budget is a plan. Bottom line, it's a money plan of revenues that are going to be generated and expenses that are going to be made. So, like this slide says, it's a quantitative. It's a money plan. It's a quantitative expression of a proposed plan of action by management for a specified period. Typically what that period is, I would say the most typical period for a budget is usually a year. All right, now the interesting thing with a budget is it's prepared beforehand. So as an example, if you are in year one, say, you are in the midst of working with the staff for a particular period, staff in a particular department, to put together the budget or the plan for year number 2. So it's always usually, a year in advance or so. So budgets certainly are not perfect, but it is a good plan. It's a proposed plan of where we want to go. And why are budgets made? Why, you might be asking yourself, why would individuals in the company want to create a budget? It takes a lot of time. It's very time consuming. A lot of companies have an entire budget analyst department. So you're hiring employees solely for this purpose. In addition to that, all of the staff members and all the employees within an organization have something to do with putting together the budget, in addition to the budget analysts. Well, the budgets help managers. That's the bottom line. They help managers manage the business. They communicate direction of the company. They communicate the goals to everyone within the organization. So we know where we're headed, what our production plans. Considering this class, we're concentrating on manufacturing. You will see that all the budgets that we prepare are geared towards production. Wow, what production do I need to meet in order to meet my sales goals? And then once you know your production budget, you'll then be able to put together a direct materials budget and a direct labor budget and an overhead budget. So certainly those costs come with the production. So it certainly gets everyone in the right direction. In addition to helping managers, budgets may also prove a way to motivate employees to meet their goals, because a lot of times bonuses or raises are based on meeting the goals or not meeting the goals. So it's kind of like the carrot and people trying to run and get that carrot. So certainly it's going to be a motivational tool as well. If it's done properly, this could work really, really well within an organization. Okay, so the budgeting cycle itself, like I said, before the start of the fiscal year, so it happens beforehand. The managers are going to work with all of their staff to get feedback, to talk about anticipated future changes in the next period. And then, of course, the managers are going to work with the senior managers are going to work with their middle managers and, of course, ultimately their entire staff in order to get all of this information. So basically, the entire organization is involved with building the budget. And then ultimately, the budget is put in place for a particular year. And ultimately, what happens is this. The budget is actually analyzed against what actually happened. And we are going to take a look and analyze the variances. The variances are the differences between the budget and the actual. And those variances will be investigated. And based on our results of the investigation, we will incorporate that into the new budget for the next year. Remember, the budgeting cycle is continuous. It never ends. So we prepare a budget, we implement a budget, we analyze the budget, and we make changes to the budget in the next year. And it's a continuous cycle. It's a never-ending learning tool, basically, about our business. So certainly investigation of the deviations or the variances are critical. And I can't tell you how many companies, they do a good job putting the budget together, but they don't do the best job analyzing the deviations or the variances. And this comes hand in hand. You certainly need to investigate the variances so we have a better budget going into the next year. So step number 3 on this slide is critically important and something all too many companies fail to do. Okay, the master budget is basically all the little operating and financial budgets put together. That's basically what we call the master budget. We're going to concentrate, of course, on all the financial budgets. All right, so let me see. We talked about this. Okay, so here is the decision-making steps. And we've talked about this in previous chapters, but let's bring it up again because this is so critically important. When we are putting together a budget, the decision-making process is going to be used. It's got 5 steps. Number 1, we're going to identify the problem and the uncertainties. Number 2, we're going to obtain information. So number 2 is so important, right? We're trying to put together a budget for, how many units to produce in a particular period. Well, we're going to look at past performance. We're going to look at environmental changes in the industry. We're going to take a look at our marketing plans. There's a lot of information we can draw upon. And based on looking at all this information, that is when we are going to make predictions about the future. And based on the predictions that we make, we can then decide on what the budget should be. Basically, making those decisions, preparing the budget, and then implementing that budget. And look at number 5. It doesn't stop at just implementing the budget. We have to evaluate the performance, which is basically evaluate the budget against what actually happened and basically analyzing the variances and learn from the variances and make changes as necessary in the next budget cycle. So, of course, the 5-step decision-making process is critical. Okay, so like I said, the master budget is made up of the operating budget and the financial budget. So we're going to take a look at both. Of course, we're going to concentrate on the financial budgets, but the operating budgets are so critical as well. The operating budget begins with the revenues budget. We need to understand what our goals are for selling. All right, and so we're going to need to know how much we expect to sell. It all hinges on that. Once we know how much we're expected to sell, then we can start to work on production budgets and whatnot. The financial budget at the end is basically made up of the capital expenditure budget. It's basically what we need to spend on fixed assets and the like. The cash budget, knowing all of our cash inflows and cash outflows. And of course, our budgeted financial statements, the budgeted balance sheet and income statement and cash flow statement. Okay, so when we prepare our operating budgets, which is so very important. And before I mentioned we're concentrating on the financial budgets, I actually got to tone that back a little bit. The operating budgets are just as critical as the financial budgets. And as I said, it starts with the revenues budget. How much we expect to sell to our customers, and from there, we will then be able to prepare what's known as the production budget. We need to know how much we're expecting to sell before we can put together a budget for production. How many units do we need to produce? Now, number 2 comes with a lot of offshoots. Preparing the production budget comes with it not only the production budget, which is the number of units we should be producing, but also the materials budget, the labor budget, the overhead budget. Remember, those are the 3 typical costs that go into production. In addition to materials, labor, and overhead budgets, we have our non-manufacturing costs, basically our general administrative budget as well. So that all comes into play. And that's number 3, the materials budget. Number 4, the labor budget. Number 5, the overhead budget. Number 6, you can see once we're done with the materials, labor, and overhead budget, ultimately we could put together an inventory budget. How much we should end in ending inventory. If we know how much we're producing and selling, we can also put together what's known as a cost of goods sold budget. Number 8 is your non-manufacturing or your general administrative budget. And then ultimately we could put together our budgets for our financial statements. Number 9, our income statement budget, and then of course our balance sheet budget. After the operating budgets, we can also put together our financial budgets, our capital expenditures budget, basically your fixed assets, your cash budget, which is basically your cash inflows and outflows, and trying to estimate what your ending cash balance should be, and your balance sheet and your cash flow statement. Budgets, of course, not actuals. What I want to stress on these 2 slides, or 3 slides I should say, are these budgets that you see listed have to be done in this particular order. You have to do the revenues budget first before you can put together a production budget. You need to put together a production budget next before we can put together our materials, our labor, our overhead, our ending inventories, our cost of goods sold budgets. All right, so they all go in order. We have to prepare them in this particular order, as you see on these last 3 slides. This is kind of a picture overview of the master budget, and it's really a summary of the last 3 slides. As you can see, the revenues budget is at top, and you can see the arrows of where we're going to go next. The production budget would be next, and then we have our materials, labor, overhead budgets, kind of all at the same time, and they all feed into the production budget. Or I should say the production budget feeds into those 3 budgets, and then ultimately our cost of goods sold budget, our general administrative budgets, which is Schedule 8 pretty much, and then we get into our budgeted financial statements. So certainly the operating budgets and the financial budgets, so critically important, and they should be prepared in a particular order. This is very, very important. Financial budgets are basically it's math. It's mathematical plans of what should happen in the future. Now, in addition to putting together budgets, some companies, if they have a sophisticated budgeting model, they can put together what's known as a sensitivity analysis. Basically, the sensitivity analysis is a what-if technique. What if we were off with our sales by 10% either way? What if sales were greater than 10%? What would all the other budgets look like? What if sales were down 10%? What do all the other budgets look like? That would be just an example what-if technique. Or what if we decided not to go through with a marketing plan in a certain location? Or something along those lines. So in addition to the actual plan, the budget, you can also do some additional sensitivity analysis as well. And this would be an example of a sensitivity analysis. So the master budget, you could see, is when we have units sold, but our selling prices are $600 for casual and $800 for deluxe. But you could see scenario analysis 1 and 2 is when we change those selling prices, or if we change the direct material costs. So certainly it might give us a different direction if we have time to do some sensitivity analysis. You can see our budgeted operating income drastically changes from the master budget to our potential scenarios. Now, another concept that you will know in this chapter is something called responsibility accounting. Now, there are certain areas where they are responsible over certain items. Each manager is responsible for something. And so each manager is in charge of what is known as a responsibility center. Now, there are typically 4 types of centers. All right. Center number 1 is called a cost responsibility center. that is when a particular manager is responsible for costs only. And there are a lot of managers where they may have nothing to do with the actual revenue, and they are only in charge of managing their own costs. All right, so cost responsibility center. Or revenue. That is when a particular department is in charge, basically not of their costs, but of the revenue being generated. Profit responsibility center is when a particular unit is responsible for both revenues and costs. So revenues less costs is profit. And then lastly, and this would be the ultimate responsibility center, is investment. Investment responsibility center is when a manager is in charge of everything. Not only the profit, but also the investments. So the investments would typically be made in the capital expenditures, the fixed assets. All right, so they're responsibility for managing their own fixed asset purchases, buying the equipment, buying the land, buying the building, buying the vehicles, managing all that. And of course, not only that, but the production, which would be the revenues less the costs. And of course, most important, the variances. You could see it's highlighted, it's bolded in black, right? Big black letters. Variances, the differences between the budget and the actual. So critically important. I can't stress enough. Obviously, this chapter is all about understanding how to put together the budgets together, but you have to take it one step further. The variances, the difference between the budget and the actual. Basically, it's going to provide managers with early warning signs, how to evaluate performance. Remember before we said sometimes meeting the budgets, meeting the goals, could be a way to evaluate managers and actually give out bonuses. All right, so certainly this is so critically important. And the best or the most important part of the variances is learning from them. So we can incorporate whatever we learned, whatever it might be, into the new budget cycle. Remember, budgets never end. They just roll over into the next period, into the next period, into the next period. Now, budgets always have human beings involved with them. And this is so important. You can see on this slide we talk about there are human factors involved. Remember, as long as humans are involved, there is going to be some mistake. There are going to be mistakes. There's going to be different persuasions. There's going to be different interpretations. There's going to be different education levels. So certainly when you get these humans involved, the budget is not perfect. It is something that needs to be considered. Take a look at what's on this slide. I love this first one. Budgetary slack. You have to be mindful of this. Budgetary slack is when the human beings that are putting the budget together purposely underestimate budgeted revenues or they overestimate budgeted costs. Now, why would somebody want to do that? Because it makes it easier to meet the budgeted targets. So that's something we need to keep in mind as senior managers or as cost accountants, to really take a look to make sure budgeting slack, quote unquote slack, is not built into the budget. So very, very important. We need to make sure that we are right on task and there's not a lot of budgeting slack built in. And that is kind of a good overview of what this chapter is all about. I have to mention that this is not nearly enough to listen to this little 20-minute mini lecture and having a great understanding of this chapter. I stress, I emphasize, this is an overview of what is going on here. It is critically important that you follow up with listening to this mini lecture to listening to my explanations of the homework. The homework goes into building the budgets, revenue budgets, production budgets, material, labor, overhead budgets, cash budgets. It is so important that you understand how the numbers flow and how to build those budgets. That was not done in this little mini lecture. This little mini lecture was just kind of giving you an idea of the types of budgets and how they all flow. So I look forward to bringing you on board and going through the homework for this chapter so we can build those budgets.